What's up, traders? We are live on Twitter Spaces. We are live streaming on YouTube as well. I'm actually going to put the link here right now for YouTube if you want to join us on YouTube. If you're joining us on the Twitter Spaces, great to see everybody here today. And we're actually trying something that I'm not sure anybody else has really tried to do. I'm actually trying to stream on Twitter Spaces as well as streaming on YouTube. And let me tell you, Twitter doesn't make this the easiest thing. So deal with us all today, but we are going to, we have a lot to talk about. We're going to have a lot of fun today. And like I said, I'm going to put actually a link right now to the YouTube if you want to join us here with Matt and I on YouTube, where we will be discussing the same things we're discussing on the Spaces, but we are going to be you'll be able to see us and you're going to be able to see Matt's charts, which I'm really interested in seeing some of the things that he's looking at as well. So actually, if you're here on Twitter right now, watching us in the Spaces, please retweet that tweet and we get more people in here. I'm going to put the tweet out right now. Cool. So that's all out. Like I said, if you guys are in the Spaces, please give us a retweet out there, get more people in here. And we're going to talk about a lot of different things today. So first of all, I'm really excited for all of you to be joining me here for the Futures Radio Show podcast, live streaming in Spaces, live streaming on YouTube. If you're joining us on YouTube, please click the like button and never miss a live stream by clicking the subscribe button on YouTube. If you're joining us here on Twitter Spaces, like I mentioned, please retweet the tweet so we can get more people in here. And as a longtime futures trader, I have learned that you guys have probably heard me say this. Everything works sometimes and nothing works all the time. Market environments change and we have to adapt or else we'll be out of business. I mean, that's just reality. We all talk about this a lot on social media. Today, my guest is Matt Caruso. He's a record-breaking investor, successful professional trader who returned 346% in U.S. Investing Championship. I'm really going to ask him how he did that. And then we will be discussing what we're seeing in the current market environment, how Matt and I are adapting, and how we're trading it. Because at the end of the day, right, it all comes down to how we're executing. We want to hear from you throughout the discussion, so be sure to drop your questions or comments in the YouTube chat. And before I get Matt in here, I want to remind all of you guys about Micro Ether Futures. They are live at CME. I was actually looking at the Micro Ether Futures before I got on today because I'm long some ETH. They are 1/10 the size of one ETH. To learn more, go to cmegroup.com. This Futures Radio Show podcast is sponsored by CME Group, Trading Technologies, TradeStation, and FTSE Russell. The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 future symbol RTY and Micro E-Mini Russell future symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. Matt, do we have you everywhere?
I think so. Thanks for having me, Anthony.
All right, everybody on Twitter, if you guys just give us kind of a heads up, make sure you're hearing both of us. I know that I could see Matt here on YouTube and we're good there, but let me know if you guys could hear Matt. Maybe put something in one of the Spaces comments or on the tweet. Let me know that you guys are hearing us good, but I think you guys should be good. Like I said, man, look at, man, we're doing something nobody's done. We're streaming on YouTube and on Twitter Spaces, man.
I just try to keep up. So many different places to stream to. I don't know where we're going anymore.
I know. I wish Twitter would make this a little bit easier. They don't let us stream through to both of them. But, hey, we're dealing with it. We've got it going. Like I said, everybody, bear with us. I'm excited to have you here today. And the first thing I have to ask you is 346%. What were you trading?
Well, it was just COVID. The bottom was happening and the Fed came out and they lowered rates to zero and everything. And I looked at my wife. I said, that's it. The bear market's over. She's like, what are you, crazy? I mean, everything, we don't even know what this thing is. I'm like, trust me, the bear market's over. The Fed is throwing the kitchen sink at this market. I mean, even if it's the end of the world, with that kind of help from the Fed, we'll at least get a bounce. And I really came to the conclusion. I said, this is a war. It's a health war. So let me go back and study some past war periods. I like the World War I period, all the steel stocks that Jesse Livermore was trading, Bethlehem Steel. And I said, I have to find the equivalent of the steel stocks. So I found stocks like Livongo and Fastly that were going to benefit from the stay at home or all of the health trends. And they just took off like hundreds of percent. I was well positioned. I stayed in for several months for the majority of the move, and there you go.
It's crazy because I remember talking to a lot of the macro people at the time saying, Danielle DiMartino Booth specifically, she was saying how the Fed did more in like a 3-month span than they during the entire QE time. And I had not known that. And because I don't follow that close enough to know those types of details. And when I had heard that, I was thinking to myself, this could really only end one way, right? If history has taught us anything, is that when the Fed is doing that type of intervention, this thing could be ready to roll. I mean, I got stubborn with it for a while, selling that you don't know when it's going to end. What were some of the things that you looked at the time? I mean, I know that you said that the bottom was in, but that bottom going up, man, that was not easy to trade. I felt it was like, I still, Trump coming on every day at 6 p.m. I'm like, here we go, getting ready, hit the sell button again. What was it? Technicals? What were the things that kept you in the trade?
So I'm kind of unlike maybe a lot of other traders. So I like global macro, even though I like individual growth stocks. I like the global macro approach. I like looking at Federal Reserve, economic policy. I really like building the whole view. But I build my viewpoint, and then after I won't act on it. As much as sometimes I'm screaming bullish or screaming bearish, I won't act on it until the technicals kind of confirm it. So I think it was April 6th, we had a fall through day, which for growth investors by William O'Neill, it's one of his techniques to help find a bottom in the market. It's a technical based tool on the indices. And when I had that click in with everything I knew about the Fed and the way I was seeing in some individual growth stocks acting, I said, this is my 5-star trade. I got to be in there and be there with proper size. Because I mean, I think everyone at some point has had a great trade, but if it's a 5% of your portfolio exposure, it's not going to move the needle. So, you got to get it in there with size, but carefully. And, I think that's why it's so important to be in the real leading stories. Because like you said, Trump's coming on or whoever, and that gives market jitters. But if you're in the stronger names, they don't back off as hard. They go up, they go faster, and they don't come off as hard. So it gives you that cushion to be able to sit through that day-to-day volatility. Even though, in hindsight, it looks like, hey, it went straight up, but that day-to-day is still difficult when you have a concentrated position.
So here we are right now coming off of a pullback.
Yeah.
And I talked a little bit about this. I actually am long a little bit of NASDAQ as we speak right now, using the futures, them in the micros. But I thought that was a pretty decent low. I don't know if it is the low. What are you seeing?
Yeah, I was tweeting that out about a week or so ago when things were really, there was that one day where I think the Dow was down over 1,000, and you could just feel the capitulation. But
yeah,
that's, I guess, my trader instinct. But what really kind of clinched me for more of a short-term low of importance was, if you look at the AAII, the American Association of Individual Investors, they had in their survey over 50% of respondents being bearish. That's to get more than half the people bearish is a really, you don't see that too often. So at least on a short-term basis. Now, a lot of people, I like the saying, it's not the stock market, it's a market of stocks. Even if the market bounces here, it doesn't mean the NASDAQ goes straight to new highs. But if the market at least stabilizes, the better stories, the better names, those can still have some good advances while the general market stays in maybe a weak state. I'm not super bullish on the NASDAQ. Like, I'm not positioning myself for a big move there. I'm kind of trying to play through some different industry trends that I'm seeing right now. So I think just what's really important is you don't want the market in free fall. That will kind of like, pour water over everything. But seeing that really bearish sentiment, that usually takes a little bit of time to wear off, even if we chop sideways for a little bit as people turn a little more bullish. But that's why I think, last week, I think it was last week now, or just the end of the week before, was kind of an important short-term low. It will remain to be seen, but that's my thoughts at the moment.
One of the things for me as more of a technician is I think that lows are so much more easier to identify, especially when we've been in a primary bull market like we have been for, really for a long time, right? You take the COVID out of it, and it just feels like we really, for me, even as a two-sided trader, I've almost only been looking at longs for vast majority of the time over the past several years. So pullbacks, to me, when they're done, they're so short-lived, first of all, and they're, I just think, so much more easier to recognize now, because when they come off, they kind of come off, and when they build, it just seems like they're, like I said, a little bit easier to recognize, at least on my tools. For you, what is the first things that you're looking for when we're forming a bottom?
Well, it's like they say, the saying is, a top is a process, a bottom is an event. Usually you see that kind of a capitulation, but there's always typically that stabilizing period, that retest, that higher low. And it's kind of always hard to tell in real time. You don't, unless like, the 2020 bottom was special because the Fed stepped in, and there's other periods where you get that as well. If you go back and you study other periods of time where there wasn't a dramatic Fed action, it just was the end of a bear market that just ran out of steam. You really need more technical time where things will usually kind of chop sideways a little bit and the uptrend takes time to go higher. But I think sentiment readings are really important. You really want to see people just give up at the end of the market. And I've seen that even in industries. I mean, sometimes, I mean, like when I started as a pro trader, I was a lot in the precious metal space. I'm in Canada. There's a lot of, precious metal companies here. And in 2011, it was, 2010, 2011, when gold was at, I think, 1900 the first time, everybody loved gold stocks. It was the best thing in the world. Like fast forward a few years later, and the space was abandoned. It's amazing when you stay in a game long enough and you follow, recurring stocks or industries, how the sentiment can shift so dramatically. I mean, unless you experience it, you can't believe it. I remember when I first started, it was a floor guy telling me, he's like, Matt, I remember near the end of bear markets, we'd be playing checkers on the floor. It'd be nothing going on. It'd be a really dead market. And those are typically the extremes of these long bear markets. But fortunately, we haven't had many of those in the recent past. And usually they've been quicker and faster events. So although I think this time here, I think we're in a bit more of a precarious situation. I can see a lot of pressure on this market going a little bit longer term. So we'll see how that plays out. But I mean, it's not always easy. It's almost like, I like to, look at it like music. You don't really know how the song's going to end. If you're playing, you want to just read the notes, they come along and adapt. So it's kind of hard to, not every bottom really is the same way.
One thing that I've noticed this year is the first day of the year is the high of the year. And in my experience, I'd love for somebody actually to pull a stat up of this. I don't know this stat, but from doing this for many years, you kind of remember certain things. I've noticed years where the opening day is the low of the year. We tend to make that range for the first 3 to 4 months in that direction. When the range is the high of the year, opening range is the high of the year, the first day, we tend to make that range in that direction for the first 2 to 3 months at least. So for me, I feel from a technical basis, also from what we hear from the Fed, I'm not really a macro guy, so I wouldn't be someone who would be the person to say that I completely know how that is impacting us. But I've been around long enough to also know that I have to keep an eye on it. That's what the one thing I look at this year as, I think, a difficult thing for the bulls to start to overcome is that you're in negative territory from the first day of the year, at least when we look at the major indices. Is that something you look at? Does that help you at all determine anything?
Seasonality, it's something I've used in the past. At one point, I was studying it really closely. And, my background is really technical first. I was a chartist first. And after I incorporated more and more fundamental into my work. So, I did a lot of background study on seasonality, even cycles at one point. And I like to keep things simple. And really, seasonality, I've just found you can go back and look at trends, you can look at stats and probability, but really, especially with the general market, there's really 2 times a year that I find there's something of importance. The big bottoms usually happen in October, and the Santa Claus rally, things typically go higher. I find that's the only thing that you can almost really hang your hat on. Besides that, sometimes things kind of rhyme, but it's never, if you're trying to put on concentrated positions and you're trying to really time, you can get a sense of certain times a year, but really those 2 periods, October and December, are the 2 go-tos for me that I try and really adjust my work around. Besides that, I kind of just go with it. I think maybe out of frustration of so many years being the exception in my table of Marches or my table of Aprils, that I just finally said, you know what, I'm just going to read price action. And unless it's the really significant time of year, I'm going to move aside from that.
Yeah, I'm definitely a level to level person myself when I look at things. But like I said, for me, it's like I guess what I'm trying to ask is, do you ever look at how the ranges are formed for the year? So like right now, we look at, where the NASDAQ and the S&P, they opened the year and they went down and they made a low. Do you look at how big those ranges are to say, okay, well, that's a decent range comparative to how we've been for the first quarter or so, to help you determine that? Because that's something that I look at in the sense of just not just sentiment and everything else, but just looking at it as a whole and saying, hey, maybe this is just it because we've kind of made a range.
It's interesting. I haven't really approached it that way, but I understand the logic you're getting to. Maybe something I'll take a look into, but I never really, I try and put myself in the position of investors. Like you're saying, if we're down on the year, how are people positioning? How are they going to rotate? How's that going to impact, maybe how they're going to approach stocks? But in terms of the range of itself, I've never really personally dived too much into that.
You know why I think about that? Because in my mind, I always think when they're looking for a low, we keep looking for a low until we find a low. Then when we find a low that everyone likes, we keep looking for highs. And that's something for me that I try to, like I said, I'm long NASDAQ right now. And it's like, I'm really, it's one of those things where I keep shrinking my moving average now. I was talked about this past week. I'm really engaging on a 10-day. We're getting so far away from it to where I'm very hard for me to sit in longs at this point because I feel like I like the low. I don't know if I love the low, and I want to be really tight with it. That's why I'm asking you that in the sense of when you find the low, because going back to what you did back in 2020 with COVID, it's hard for me, aside from like maybe that specific instance, and I figured it out later. You figured it out earlier than I did, to know to hold that trade. Like maybe not just the ranges or certain things that I'm talking about, but what are you doing to help you? Maybe at this point, if you're long anything, maybe talk about maybe if anything that you're long to try and hold it and see how far you think it could go.
Yeah, that's something, it's really a combination of technicals and fundamentals. And I find that's really important because you can't hold on. Like, I mean, when I was buying, Livongo, it's 27, then it's 40 and it's 46. Before, I guess, I think I got in the 140s. To hold that entire time, it's really difficult. I mean, you're sitting at 70 and you can see, that 50-day average is down at $50. You can see that $20 drop. It's very difficult to hold on to. And that conviction is what's going to do it for you. That's why I like to incorporate a lot of fundamental work, just in terms of understanding the story, understanding the potential, where can we go with this? In terms of the actual technical basis, I do a lot of work on the weekly charts. And William O'Neill, in his book, How to Make Money with Stocks, he gives some great guidance on this that's really influenced the majority of my work of holding. And he goes back and studies a lot of market winners. And if they break out of proper bases and they have all of the right fundamentals and the story is in place, there's certain minimum times that they're going to run. I mean, it's not 100%, but I mean, you have like high probability. If you go back at all the leading stocks, they're going to go at least 4 months or more before you run into some kind of major trouble, not just a short-term pause. And so I really guide that when I'm putting on my initial positions. If they can really blast off and I feel I have a market leader, I'm going to try and give it that, 3-4 months to work. And then I can reassess. If everything that I understood about the company is running true, I can see more potential, I have a huge profit cushion, then I'll reassess about holding longer term. But it's that price action after the buys are triggered, after the breakout. Is the market confirming my thoughts? Or do I have this great bullish idea I came to because I love this company, I've been to it, but then the market reaction is meh, it's a pass. Like clearly investors are not piling into it. If you see these fund flows come into these companies or even the market in general, I mean, like you're talking NASDAQ, you see these 90% up days and these power moves. That's telling you the market is also recognizing what I'm seeing. And once you're on key, it runs, for an institution to put on a position, that's going to take months. And the institutions are what push these things.
Let's work back a little bit because we're going to go to the charts here, everybody. So if you're listening in the spaces, you can hop over to YouTube and we're going to go to the charts here with Matt in just a little bit. And I want to, let's really stay current to this current market right now. We see this low that has potentially been made. We call it a low, but it's the low that we have for now. First things you start to look at is it, I titled the show Market Environment because the market environment shifts, right? What is the first thing that you're looking at to determine this market environment could be shifting? I want to start looking for market leaders, all the things that you talked about. Walk us through, and then we'll go to the charts to see what that looks like.
So I've really learned over my years is that the best time to find a winner is a market correction. So it's frustrating. And a lot of times people kind of walk away and they're missing the time to uncover what's going to be the next leaders. And this drop in the past few weeks has been this exact same thing. The market, the NASDAQ fell 20%. And if you take a look at oil companies, potash companies, they didn't fall. I mean, the reason a stock is not falling is because the institutions are using this weakness to buy stock. And if your company is falling 50, 60% with the backdrop of a weak market, the guys with the best research, with the deepest pockets in the room, passed on buying your stock when it was only 10 or 15% down. They're waiting now that it's down 70% to start buying it. So clearly it was overvalued. And so that's the main feature. So I kind of use the market. I typically don't trade the market directly. I just use it more as a barometer of how aggressive I should be with my individual stock positions. I know if the market's going to enter a bear market, that's going to pressure everything. But it's really that barometer. So I kind of use it as an exposure gauge. So when I see a positive market environment that we can look at, I use net lows, net highs to gauge that. If I see a positive environment, I'm going to be fully invested with leverage if my positions are calling for it. if I see a back and forth, one day we have net highs, one day we have net lows, the market's trying to find its footing, I'm going to start raising cash. I'll probably have 20, 30, 40% cash, depending how my positions are acting. And if, like recently, we were really looking at net new lows every day. Every day there was more stocks making 52-week lows and 52-week highs. It's not that I won't be in the market, but I'm probably going to have at least 70% cash. So if I'm going to play, because I mean, we've all been there, right? If you trade long enough, you can kind of convince yourself that you found the bottom and you haven't. And if you're playing aggressively, you'll blow yourself up. So those are my general guidelines. If the market indicators are telling me, hey, we're in a bad market environment, sure, you have a great idea, take some exposure, but you're not going to get in there too heavy until you get more confirmation. That's kind of my process and how I use the market to gauge my exposure. And then I actually move into the individual stocks.
I don't think people look at the reaction to stuff nearly as much. I think everybody gets so focused in on what is the signal, right?
Mm-hmm.
Versus what is the reaction. So what you're saying to me is that you wait for the environment to set up for you, and then you're getting confirmation through the feedback from the market, correct?
Absolutely. Yeah, absolutely. I think everyone is, and I think I've been there myself, especially, you get a technical analysis book and they show you all the buy signals, and that's the holy grail, right? I find that great buy signal. But the thing is if you study enough charts, different environments, the same buy signals will work fantastic in some environments. I mean, it'll be like the Midas touch. Everything, every time it shows up, it's a golden buy. And then after, in the wrong environment, it's awful. So the way I came to adapt my approach is when I have the signals that the environment is healthy, it's just so much easier to take these buy signals because they all start to trigger, they all work. And when I have a negative environment type of signal, then I definitely, I assume there's going to be a higher failure rate. So I dial back my exposure.
What are some of the things that you look for that give you the confirmation that things are working to now start to get, we'll say, more aggressive?
Profits. If I'm buying a stock and it's moving up.
P&L.
P&L. And, for years as a day trader, a market maker, you have that P&L like just right in front of you all day. I mean, it's just, for me, it's just habit. I'm always constant. I look at it as my own personal index. The S&P is the S&P 500. Well, my P&L is the Matthew Caruso index. And is it moving up? Is it in a bull or bear market? And that's how I always gauge am I right or not? I mean, the market is the most fair place in the world. I like to say they'll tell you right away if you're right or wrong. There's no second guessing it. If you're making money, you're right. If you're losing, you're wrong.
It's amazing to me how there's really a lot of divide between looking at your P&L versus not. Everyone says, not everyone, but there's a lot of people that say, don't look at it. I'd never look at it. Just trade the market. Other people say, I have to see it. I'm one of those people who I look at it because, similar to what you say, if I'm doing good, that's feedback telling me, hey, man, things are working. Recognize it. If I'm trading over my skis, right, and I'm getting beat up and I see that my P&L, I'm getting clipped, and anyone could tell me that, oh, Anthony, it's all about managing risk and all that. Sure. But yeah, you don't tell me you never get over your skis, because that's crazy. It happens. At least for me, it does. And I'm like, okay, man, look, you're getting hurt early in this trade. You got a lot of room to go. Step back, reduce your position size. It works both ways. And when I do see things that are working, I'm very similar in that matter. And I think a lot of traders listening to this, it's like, if you can control that in the moment and look at your P&L, it does give you a lot of feedback, winning or losing. And I think it's something that it's not black and white. You should or should not look at it. It depends on, I think, who you are as a person, if it makes sense to you.
Yeah. And, at the same time, I think it's just important for risk management too, because I know I've been there. Sometimes you're in this position and you're dead wrong. You don't want to accept it. You keep looking online to find some kind of information to agree with you. You keep looking at you look up the symbol in Reddit or on Twitter. Some guys got to also see a bullish, and you're losing money. You're dead wrong. You're concentrated, and your risk will finally tell you, I have to get out of this thing before it just becomes a disaster. And then it's amazing once you get out and you cool off, and it's 3 hours later or the next day, you almost look at yourself, what the heck? What was I thinking? I mean, I'm so obviously wrong. And then all the stuff you didn't want to see that psychologically you were kind of blocking out, like, no, it can't be, all becomes clear. And like, yeah, I mean, this is the wrong idea that I had. But that's why the P&L is so important to me, because if I'm getting, really beat up, I have to get out, because sometimes it's amazing how that P&L, how that just your account movements and your frustration will really impact your thought process. And I think as you gain experience, I think the biggest hallmark of an experienced professional is not necessarily what are their buy signals or sell signals. It's how well can they assess that they're going off, or that they're on, or that they're working well, or if they're really, it's psychologically not clicking. It's the psychology that has to be mastered long term, because most of the buy rules, I mean, there's not that much new, unless you're writing some kind of HFT where it's really rocket science. I mean, most of the stuff most people are doing, taking positions, holding on to trends, this has been known for decades. I mean, even William O'Neill wrote his book, his first one in the 80s. He referenced the stuff from decades prior. Edwards McGee was 1948. Jesse Livermore had his book in 1927. And everyone's saying variations of the same that are refined and slightly better, but it's nothing earth-shatteringly new, So it's really, I think the hallmark between the successful investor and the person who just can't get it right is learning to adapt to your emotions, keeping that discipline, and realizing, Matt, you're going on the wrong path. Your time to refocus. I think that's the difference.
I talked about this recently. I was on another Spaces with the Trader Lion crew. Love those guys. And
yeah, good guys.
I think it was Nick that asked me. It was something about how do I deal with the drawdowns, or I forget the exact question and how it's set up. But I remember a pit trader coming to me and saying, "Hey, Anthony, you're doing good. Keep doing good. When you're not doing good, go spend money. It'll save you money in the market." And that really triggered something in me, because I remember at the time being like, "Is this guy nuts? He wants me to go and spend money when I'm losing." And the whole time I'm thinking about this for, who knows how long that time span was before I finally started to recognize it, was when you're doing good, you stay, you press, you keep doing good, you take that feedback, you just keep taking from the market. The market does not lay up on you. And when the market's giving, you better be taking. And when the market's taking, because it's going to happen, give less and go spend money. I remember the first time I did it, I went and spent like $500 on something. Who knows? I probably went and bought who knows what. And I remember being like, this is just ridiculous. And I remember seeing the day, and the day was all choppy. And I'm like, man, I probably saved a good amount of money here just by thinking that. And it's sometimes I think we need these psychological things to, maybe it's just not as easy for somebody to understand that when it's going your way to add, or when it's not to step back. So that was something that really triggered in my mind to understand that psychology when it comes to doing what you're saying. It takes me to my next question is, I've spoken with a lot of people, the William O'Neill methodology and things like that. Why is it that you think that some people are extremely successful with that type of methodology, and while others will say, I can't make money trading that?
It's a good question. And I myself struggled with it for a long time when I started. I mean, I always lost money with it. I mean, it was really frustrating. And I just refined it over time. But there's, that book, for me, at least, I mean, you could see the books, this is just a fraction of my library of technical books that I've read. And that book, there's no book that kind of rings true over time than that one, maybe along with Reminiscences of a Stock Operator. But the unfortunate thing about that book is that it's so well written that it seems simple. And he, William O'Neill boils it down to the most important elements that you need. But the application is not simple. And the human element gets involved, and there's something that we develop over time. Like I've heard others call it chart eye. Like your eye gets used to looking at chart patterns, and you can decipher one that's shaped well, one that isn't. Just like a doctor can quickly look at an X-ray or whatever it is and say, oh yeah, this is a broken bone or whatever, and you have no idea what he's looking at. That's a skill that develops with time. And so William O'Neill was a master at that. And now looking back at the charts, it's like every time I go back and study, I realize, I was really looking at that the wrong way. And you refine your process, you get better. And most people don't have the risk management skills, the positioning skills, again, the psychology. And those are so important. Again, everyone's so focused on what to buy. What to buy is like saying, I want to build a car. I just want to worry about the engine and the gas pedal. If you can't turn corners, if you can't brake, if you can't, if your car can't withstand the intensity of driving at 200 miles an hour, it doesn't matter how fast you can go. You won't get to the finish line. So I think that's the real difference, is that the people who are successful with it have gone up and down, have lost money with it, but they just, with any, and it's any trading style is the same story. I think, it's just, this is one that resonates well with me, but for years I was day trading, swing trading. So, I mean, I've done different styles, but I think just the key is that it's the experience, it's understanding the essence of what he's saying, Bill, and getting beyond just the numbers of what he's trying to put there in the chart patterns, understanding why is he approaching the market like this. And that's a really big differentiating factor. At one point in the book, He talks about when he started out, he studied Jack Dreyfus, who had the best funds at the time, and he ordered like the prospectus from the fund, and he realized Jack Dreyfus was a chartist. He was buying breakouts, and that led him to buy these chart patterns with breakouts. But see, what he did was he didn't ask for the trade log of Jack Dreyfus and try and mimic exactly. He said, what's the logic underpinning what Jack Dreyfus is doing? He's looking for a consolidation. When the market breaks higher, we know that the trend's resuming and I'm getting long. So people have to get past what's a buy point, what's a buy signal. Why are you doing it? How does that work with the rest of your system? What size are you going to put on? When do you cry uncle and use your risk management? When do you sit there through volatility? That's the difference between in anything. You could play little league baseball, and then there's an MLB player. You're both playing baseball. Why is one guy getting paid $20 million a year and one person's paying to play? I mean, it's that difference of refinement and keeping the whole system together that's important.
Listen to that, everybody. I mean, this is why it's so important for you to find a style and a market and environments that resonate with you, because it's not just as simple as learning a methodology. I put this tweet out a while ago. I said, there's a big difference between learning how to trade and learning how to become a trader.
Yeah.
And
Big.
to me, it really comes down to, I think, initially finding those things that resonate with you, finding the markets that resonate with you. You like stocks. I like futures and crypto. Everybody likes what they like. And I think you have to have this, I think, personality that fits with it. It's not just, hey, you learn this style, this will make you money. You have to really believe in it. And you have to, like I said, I think it really just comes down to resonating with you, because then you'll give that full commitment to learning it and going through everything you discussed.
And I'd also say, just speaking with you, I can tell that you trade. I mean, there's a certain psychology when you do this and you do it with your full heart, and especially if you do it full time, like the full-time trader, the full-time investor who lives off of the market, and the part-time investor, drastically different. And when you're living off of your performance, when it's up to you to deal with good times, bad times, there's no one there to save you. You become driven in a different way. And I mean, not to say that you're better than someone who's doing part-time. It's just that the pressures and the way you're forced to adapt and understand yourself, there's no safety net. And so it really makes you approach it in a different way. And I find everyone I know that's traded professionally has a very similar mindset. You all trade differently, but you have a very similar mindset about how you think about the markets and how you think about positioning. That's at least my experience.
No, so well said. Now, Matt, we're going to go to the charts. Sure. And so everybody here, in just a second, we're going to pull up the charts. Like I said, if you're watching the spaces, you can hop over to YouTube. And, if you follow me on the show or social media, you know that I post a lot of charts using TradingView. And on TradingView, I connect my TradeStation account to be able to trade futures right there on TradingView. That's pretty cool. I love that option for TradeStation customers. And to become a TradeStation customer like myself, you can get 50% off your brokerage fees. You can go to tradestation.com/Anthony. Here we are with the charts right now with Matt. So actually, might pull this up into a complete full screen so we can see it. You and I are going to drop off here just for a second, but the screen will Perfect. Be full. Okay, cool. So I am reading the chat. Christy's asking if I'm reading the chat. I see all these questions in there. And yes, everybody, we are going to start taking your questions in the YouTube chat. So don't worry, we will get to them all. And I saw a lot of these questions. The first thing I want to do is, Matt, we kind of talked about how you look at the bottoms and what you're doing to determine the market environment. I think maybe if we could just kind of start there, just kind of show us as the market was making lows and it started to change, maybe just pick NASDAQ or S&P or whichever, any one of the major indices, just to kind of gauge how you look at markets when they're making lows and maybe how you think the environment's shifting.
So just the main tool I like to use for general trend is in this bottom panel here. This is just really simply the net 52-week highs, lows for the NASDAQ. So if there's 100 new highs made that day and there's 20 new lows, that means you're going to get a net number of 80 net highs. And so if you go back in time, and this is what I'm talking about, environment, you'll see that. Let me just fix the scale here. When the NASDAQ was really in its strong uptrend over the past couple of years, you constantly have, obviously, which makes sense, more stocks making highs than lows. I mean, it only stands to reason. But as the market starts to top, like we said, topping is a process. And so really, the market started to lose a lot of steam, even into summertime. And so we had a little bump into year end. But you can see that right near the highs, actually, as we were making all-time highs, you already had more stocks breaking down, making new lows than new highs. So that's the environment that I'm talking about. And that's just so important. This is such a simple tool, and this really helps me guide my exposure. I don't use this. So, it's funny because I'll post this every day on Twitter, and it's really a guide. And there's always some people will say like, oh yeah, but back here in August, you had net lows and that was the bottom. This, you have to understand your tools. It's similar like a sniper rifle. You're not going to use that in close combat. This is a trend following tool. So you're looking for a new bull market to form, and you want that confirmed with net highs. There's always going to be periods where you get a little bit of market weakness, and after returns higher, that doesn't bother me, So that's just part of your positioning. But what's important is not being off by a day or two. Just because you get net lows one day, you don't got to dump your entire portfolio. You have to start to realize there's something might be wrong with the market. And that's what we saw here in late November. And it was even more apparent because all the leading stocks that I follow, the high beta stocks, the stocks that are outperforming the market, besides the mega cap NASDAQ and the mega cap Apples and Nvidias, everything else was already breaking down. So internally it was really obvious. And when the majority of them were breaking down, to me, that was just a really big, warning signal. So fortunately for me, I was completely untouched by this entire market drop because I was either in cash or just more recently, I was buying some energy and potash names, which we can discuss later. And there's no magic to it. I was really just following the internals. We had a lot of breaking down. Individual stock plays were not looking nice. And that combination just led me to have a lot of cash exposure.
Real quick question. Do you ever short anything?
It's funny. My first year trading was 2008. It was the financial crisis. And I had a good year, but, I almost never shorted. So it doesn't call to me the same way. I do it sometimes, like when we were in a really deep bear market, but I always cover too soon. And it just, like you were saying before, know your personality, what works for you. For me, shorting is just kind of like keeping myself involved somewhat in the market. I'll never do it with a big position sizing. It's just kind of keep me interested, but it's not something I focus on.
And, it's interesting for me. It's just my biggest trades have been short.
Okay. Yeah. There you go.
It's crazy. Well, because I think that's really also something that people that trade stocks versus futures have to, understand. I think that there's a lot of differences. I think psychology wise, we're very similar. Obviously, when it comes to the margins and the leverage, when it comes to futures as a leverage product,
right,
it is different. And because obviously the futures radio show, I want to talk about this a little bit, is that when we go down, the moves are so much quicker and they're just so much sharper. And going up, I've always noticed this when it's going up, like one of my friends, Tom Canfield, I talked with him about this canning. Mm-hmm. I was like, it's amazing. Like we trade psychologically. I think we have a lot of similarities, and he's really helped me understand how to trade stocks. And for me, I understand more from learning from him and how the environments he looks for, because we're going up, and what he's looking for and how he takes advantage of that. And then for me on the future side, it's like, I like it when everyone's kind of screwed up. I like it when it's really volatile because it gives me that in and out type of a mentality. And it really helps me understand also that when the stock market does start to get in this bull type mode, and I know guys like him and yourself that are doing well and you're understanding this environment, that's harder for us. Mm-hmm. It really is. So it also is another thing. I know we're talking about market environment today. I think that's something that I think a lot of stock people could look at when the futures markets start to get busy, is to say, hey, that could be almost a trigger to help you understand. And when we get really wild, I think that's almost makes your environment a little bit more difficult.
Absolutely. And the stock market, a lot of people try and hold positions for longer term, but they try and get involved, or they try to initiate during these really volatile periods. And then just a normal down day, like these bars look small here, but these are dramatic moves. It's enough that, if your stock falls 10 or 15% on a reversal, you're out of your stock before it ever moves higher. So, understanding volatility, if you're short-term in futures or trying to put a position on in a different type of stock, sometimes your strategy is not going to compute well. It's not going to be a well-rounded strategy. So you have to kind of really make sure that every element of that strategy works together to the same final goal. And by the way, I love following Tom on Twitter. He hasn't been tweeting as much as he used to, but everything he writes, I feel like he's speaking to me directly. That's that experience. You can tell right away that Tom's definitely someone who has had his share of market battles.
Yeah, he's the best. He knows I love him. Now, remember, everybody, if you're on the Twitter Spaces right now, we are on the charts over in YouTube. So what are we going to look at next, Matt? I know we talked a lot about really your process so far. Maybe take us through either the names you're looking at or just walk us through some of the indicators you have on your chart as well.
So I always like to go, I'm always technical based, but I always like to build the story in my mind. Even when I was day trading, if I was bullish gold, I'd have a reason why. And that would every day drive me to try and be a buyer or seller and back and forth. My mind's always worked that way. And that's why big picture stuff has always appealed to me. And right now, I mean, I think there's just, you can see this is the NASDAQ has taken a really big beating. And if you look at oil, the oil contract, I mean, oil's just been really strong here. I mean, we're back at highs, and there was this drop here due to Omicron, and President Biden released some oil from the Strategic Petroleum Reserve. The market just bought it right back up. I mean, whenever the government or some kind of entity tries to intervene and it fails, that's just a screaming buy, because I mean, they tried to stop it, they couldn't stop it. I mean, it's really a strong move. And so that's what I mean by you want to be in leadership. So that really guides my exposure. And even though the market was breaking down, that's the best time to see which stocks are leading. And so I really keep my charts pretty clean overall. I don't have a lot of indicators. I have basically the net new highs and lows on the bottom. I always keep the NASDAQ or S&P above me to get a general market view. And I use this background coloring as something I created. It's an adaptive relative strength tool that I use. It helps me to show if the product is showing relative strength or not. And you can see oil was really demonstrating relative strength from way back here. And so, my current understanding of the markets is I'm really bullish oil, because I think it's a very tight market. OPEC just spoke again today. They're not going to do any kind of major increase in production. If you look at the American shale producers, which were really flooded the market with oil in the past, all of their board of directors have all been changed because of, in 2020, oil went negative and they were under so much pressure. The boards have changed. They're ESG focused, because that's the only way you're going to get access to capital markets or reasonable access to the capital markets in the future. Also, so they're focused on returning cash to shareholders. So they're not just going to go out there and just produce oil like they have in the past. So oil, the supplies are very tight. And in the States, I mean, I can't speak to the States, but in Canada, we're having kind of like a mini, a revolution going on here with all the truckers really demanding that all the mandates stop. The UK, the mandates came off for COVID. I think if the world just finally says, look, we're going to live with COVID the way it is, and the mandates come off, you're going to get this surge in demand for oil. The supply won't be there, and you're going to see oil go, much higher is my general viewpoint. So that's how I kind of build the story in my mind. And that's why I've been working with stocks such as Devon Energy. We can see here, this has been a very strong stock. Again, my relative strength has been showing that this entire time pretty much. And so when the market started to sell off in this area here, we pulled back to the 50-day averages. We came back through, and I could see the strength in the stock. I started to get really a position long pretty aggressively in the 44 area. And I've still been adding recently. And so this has really been pushing higher. A similar story with Diamondback Energy. Really nice basing structure. If we were to go to a weekly chart, you can see it's really nice how the volatility has been controlled during the basing process, but really is that standout relative strength versus the market and the fundamentals and the potential for higher oil prices. Bringing that whole story together is what really gets me excited.
Another time where I want to talk about futures a little bit, obviously futures radio show, but you're looking at the price of oil based off of the futures price.
Right.
And to me, there's no better place to look at it. So I know a lot of people out there that are trading these oil stocks that are following Matt. I mean, symbol CL, it to me is something you have to look at if you want to get an accurate price on oil. And, you can look at the months out and stuff like that. When you're looking at oil, are you looking at it from a technical basis as well as you are with the names, or do you just put a line chart up kind of like how you did for the S&P for oil?
I like to look at it technically based. I'll go back in time to see where there's going to be some points of resistance. Also, like you mentioned, it's always great. It's very rare. When does a commodity bull market happen that's not in backwardation? So typically, the current contract expiring is going to be priced higher than the forward contracts. That's just typical of any bull market. So I always like to see that as well. And, I had quite a bit of experience before I started trading pro and I was a teenager. I mean, what's better than having, all the leverage of a futures contract, right? I mean, all I had was my McDonald's savings when I started trading, by working part-time. So to leverage that through the futures market was the way to go. So, and back in, 05, 06, 07, there was all the grains, soybeans, wheat were hot, copper, oil, gold. So I was really trading all of the actual futures contracts. And so I kind of have a good understanding of it on that basis. And even the next, stocks we'll look at, which is, I think, the fertilizer stocks, that's driven by, you want to keep an eye on soybean prices, wheat prices, corn prices. And it's really made, some people, it's unfortunate that more stock traders don't follow futures, even at least somewhat, because, it's the global supply chain that, can lead to some very important dramatic moves. So I think I always keep an eye on it, even if it's not always my focus.
I mean, it's just so important, and it's amazing to me how many people I know that don't know that. I mean, that the
Mhm.
futures market is where that's where price discovery is happening for the price of these commodities. And so, if you're trading these stocks based on oil or any sort of commodity, futures are obviously the best place.
Yeah.
Um, I know a lot of people are asking. I'm seeing some questions here and there about what are the names that are pointing out to you for the leadership right now. I know you've been talking about oil to the upside.
Yeah.
Is there anything else that you're looking at to help you really determine the leadership of this market?
So I think leadership is really defined by two things. One is its price strength. So the leader absolutely has to be advancing before the market or stronger than the market. That's the number one definition. Two, there has to be a fundamental basis. If you're a $3 stock that's just doubling because of some short-term momentum, you're not going to be a big price leader. You want to be of a decent market cap, and there has to be a good fundamental story that will attract institutions to bring money, deploy it there, and drive it for a longer term move. I think that's really critical. Those are the two real factors I watch. And the tech stocks have been so great to everyone for a couple of years, and unfortunately, technically, they're so beaten. Not that they can't have a reflex rally up, but they're definitely not leaders. That takes time. Once there's that kind of a break, the only places I see really good strength right now, and it's not great for the broader economy or for maybe most people who don't like those sectors, is really energy. And I really like the potash situation. There was actually really big news yesterday that came out of Russia. People, I mean, and this is important for even general life, is fertilizer prices are at I think higher than they were in '08, which was their prior peak. That affects your food prices. That affects a lot of things in the economy. And fertilizer is really important in the food chain, and ammonium nitrates is a big component of fertilizer. And Russia produces 2/3 of the world's supply. And yesterday they came out saying for the next 2 months, we're not going to export any ammonium nitrate because there's so much demand, internally. We're going to keep it for domestic use. That's like quite a shock. That's why I think Mosaic here had such a big up move yesterday. And similar to Devon, as the market really came lower here over the past, few weeks, Mosaic's actually entered into a pretty nice uptrend. And this is a general, this chart pattern in general here is a cup with handle pattern. So you have the great story. I mean, food prices are really strong. If you look at the grains, fertilizer prices are hitting records. These companies are making phenomenal earnings, and they're leading the market. You're back at highs. You have good price and volume action. Another stock in the same group is CF Industries. You can see here as the market's rolled over and come down. I mean, the market is lower now than it was in October and September, and CF is significantly higher. Again, you have really big price and volume action on the upside. To me, I think these are the leaders of this current market. And for most people who haven't been trading a long time, to me, it's funny. I was talking with a friend of mine that I used to trade with at the bank. We were on the same trading desk together, and we were saying, "Hey, look, it's 2006, 2007 all over again. All the same stocks that were the big performers back then: CF, Mosaic. Now there's a Canadian giant. It used to be Potash. They're Nutrien. They merged. They're all coming back to the leaders again. So it's like the cycles come full circle. But these stocks usually aren't sexy, but at the right time, if there's supply constraints, they can have really dramatic moves.
So when you find a sector like this that's a leader, are you basically just only focused on these names right now? Because to me, it sounds as though you just like to trade, and correct me if I'm wrong, obviously, you like a leadership sector, or you like where the leaders are, because it goes back to kind of what you were saying earlier. I'm getting confirmation that these are doing good, so I should keep doing good in these names.
Yeah, absolutely. And
Okay.
it's nice sometimes, because, I like to be concentrated. So if there's only a couple of sectors, your portfolio volatility is going to go up because you end up being very heavily invested. It's just the nature of, I guess, as a professional investor. Yeah, I like being fully invested if I can be. But then after something goes wrong in oil or something goes wrong in the potash sector, it's a big part of your portfolio. When it's a healthier market, let's say, where there's more sectors participating, you could have a big position in internet technology. You could have a big position in a healthcare name. You could have a big position in I don't know, let's say some kind of a retail chain. And so you get a little bit of at least industry diversification. But in times like these, if these are the only leaders, I'm not going to diversify for the sake of diversifying. I mean, I'll only do so if I see like equal opportunity elsewhere. So I'll just keep trying to add and build my position as safely as I can at different points.
Couple questions. How many names would you be in at one time? And how long is your average hold time?
So it's funny. The names question is an interesting thing. There's one of my closest friends. He's also a professional trader, And we would for years be trading the same stocks like next to each other, and I would always have 5, 7 names, 8 names, and he would have 25 or 30. I say, Harry, how do you manage 30 names? Like, no, that's the way you got to do it. It's just the way he liked it. He was comfortable. Once I get past 7, 8, 9 names, I almost can't keep track of what's going on. I like to stare at price action and like read every movement all day long. Every time how is the stock reacting? Is there something funny? What was that big trade that happened or that quick move? And I just to be aware of what's happening. So I feel comfortable, unlike I think most people, and with the natural reactions, I feel comfortable having only 5 or 6, 7 names. Beyond that, I get uncomfortable. So whereas most people like having more names to feel like they're diversified, for me, it's the opposite. I want to have concentrated. I mean, within reason, obviously, you don't want to have everything in one stock all at once. But I feel like I can adapt quicker to market changes that way. And for holding periods, it really depends. I used to be a day or swing trader, but with the current strategy as I'm applying it, and that's my focus now for a few years, several years. I'm looking, it doesn't always work out that way, but I'm looking to hold for at least several weeks to months. I don't usually go past 9 months or a year. It's just my nature, but at least weeks to months to get a good, solid trend that will return some sizable returns.
How do you work stops and targets? Do you work stops?
I kind of do something that's a little bit different. Is I like to have like a dollar stop. So I predetermine what percentage of my account I'll want to lose on a trade. Then after, just instead of doing percentages, I'll figure out a dollar amount so I can work with it day to day. And that really, I developed that because at one point a few years back, I'd gone through like a drawdown, and I was getting nervous to put a trade on. You've been there, Anthony. It's like you can't do anything right, and then you just get frustrated. And I said to myself, you know what? I'm just gonna, because when I started trading at the bank, I was the youngest guy, and I was sitting next to the oldest guy, and he was a really nice guy, Franco. And he told me, Matt, no matter what's happening, I don't care if you're trading 100 shares, 10 shares, never stop trading. He's like, if you stop trading, you're going to lose your edge and you won't be able to trade anymore. He's like, never stop. And so I always took that to heart. And so I got to the point where I said, I'm feeling kind of gun shy here. I don't really want to get in there, but you know what? I'm okay losing X number of dollars. And I said, I'll put on a position. If I'm down that amount of money, I'm going to get out. And it worked so well to calm my psychology. It became like a staple of my trading approach. So I always begin with a dollar stop. And as I add to my positions, I personally keep that dollar stop the same. I'm adding on strength. So even though my position can get really big as a percentage of my account, I'm still only going to lose that same amount for my account. So it's giving me a lot of comfort on how to trade that way.
I want to stay on that just for a second, because first of all, I want to know how you would determine the price area versus the dollar amount. For example, let's just say that you bought something that was holding above your moving averages, and you say, I'm going to risk $5,000 on this trade. Okay, well, what happens if it starts breaking down on all of your stuff? Is it the dollar amounts getting you out before price does? Or does price then intervene and say, this is no longer working, I'm going to take my loss?
So the dollar loss is always my worst case situation. So I don't want to lose more than that amount of money. I want to move on to the next idea. If, let's say, I put on a position, like you said, and the support is, I don't know, $30, and we break that with volume, and I'm only down, let's say in your example, $3,000 instead of the 5, I'll exit before. I mean, I'll always exit earlier if I feel like that the trade has changed. I won't step beyond my $5,000 loss just because the price, the stock chart will only break down $5,000 lower from here. It's like risk management comes first in that case.
Got it. So when you get into the trade, you are saying to yourself, this is how much I'm going to risk on this trade.
Right.
And that is determined not how far away the market can get away from where you potentially be wrong. I guess what I'm trying to come to figure out is, let's just say that you have something that you really like, and it's holding those moving averages that we were looking at in the chart.
Right.
At that point, you're saying you're gonna let that work until maybe it starts to prove to me it's no longer working with the price action. But if it blows through an area, that's the amount I'm risking.
Yeah, exactly.
You're not basing it on, okay.
Yeah, I know a lot of people will say, like, my exit has to be the low of this bar. And I mean, in general, when I'm putting on the position, I want to keep in mind volatility. Like if I only want to withstand, let's say, a $5,000 position, I can't put on you can't put on a $50 million position and expect to sit through normal volatility. So you have to factor that in, but that's kind of pre-built into my position sizing, so that my dollar stop is a reasonable amount of percentage move on my position when I buy it. So you have to be realistic as well. But it's just simpler for me, even if sometimes they'll get stopped out in sideways action. But it's an amount of money I'm willing to lose that doesn't mess up my psychology. I'll get back in if it's just a small shake and then we break. Like look here, this low broke this prior low here in January 14th. Then it took off and it broke the downtrend line and took off. So if I would have got stopped out earlier or right at the low, okay, unfortunate. If I buy this back on the trend line break, if let's say that's the trigger, but I think that CF can go to, let's say my aim is for a move to $100 or $125. Well, I had a $2 loss, but if my goal is $60, I mean, there's enough asymmetry there. There's enough huge upside to offset for a few downside losses. But that goes back to your overall strategy and approach. When I was day trading, it was different. Right now I really demand asymmetry because I'm a trend trader. So I want big gains and my losses are small. When I was day trading, my wins and losses were always about the same size, but I had a high win percentage. So, people go around and say, this is the way you have to. There's no way you have to trade. Your strategy's got to make sense. Your strategy's got to be cohesive, and it's all got to work together. Because I myself have made a living trading different strategies along the way. So it's just important that it all works together.
I agree. And, for me, I go into every single position knowing how much I'm going to risk, but I determine my position size based upon the price that I know the trade doesn't no longer work for me. I think this is also a big difference between when you're looking at trading stocks versus futures, especially like right now I'm in this E-Mini NASDAQ. I mean, this thing, it's like, if my dollar amount, it has to be, I have to know that price to have to work a hard stop, because I could blink and this thing could be just ripping my face off.
Right.
So I have to kind of trail them and know exactly where it is. And I think with some of the way that you're going about it it makes sense to me, because I think that when you put that risk per trade out there beforehand, you're already starting to heal. You look at it like, I've lost $5,000. I'm healing already. You've already somewhat accepted that loss. I think that to me is one of the most important things you have to do before you get into the trade. And, I will all go out there and we'll probably, I'd love to say I'm perfect and say that it always is that case, but I really will be really disciplined in my stops in those risk areas. Because to me, I've already healed from that price, from that risk amount. And that allows me to then focus more on the market. When people say focus more on the market, that's something that I think is important, is to know that number before you get in. We've only got a little bit of time left. So there's a couple of things I want to get to quickly, and I want to get to some of these questions. One is, as they start to go your way, are you scaling out of these? Angela, you're reading my mind. That's the question I was going to ask him. Is it all in at once also, or are you scaling in, scaling out?
So I'll scale in, but to get out, I'm typically getting out all at once. I mean, that's usually the way I like to approach it. I mean, it depends the overall portfolio. Let's say I'm running really hot. Let's say I got, let's say in 2020, you're invested 150 or 170% of your portfolio. And you say, oh, if the market's getting extended, I'd like to take I'd like to dampen the next big correction. I'll look around. I'll look at maybe the names that are a little bit weaker, that haven't participated as strongly, and say, look, I'll take maybe half of this one off, or this position altogether off, because it's weaker. That's kind of the portfolio management side of things. But my aim, the real aim of what I'm trying to do, is to find a big leader that's going to double or triple, have a big percentage of my account in there, and ride it for the whole move. So the problem I've seen about kind of taking it off a little bit at a time is that it shifts your mindset from trying to hold on to this leader to where you're piecing it off. And the more you piece it off, the easier it is to take off more. And then after, you only made a 50% return when your aim was for 250%. So the 250% does come, but you're only left with 10% of your position. So it's kind of, because of my stated end goal, that's kind of what impacts how I approach the entire position sizing and selling process.
Hearing you say that is something I go through regularly. I've been doing this for a long time. It's like, I'm a scaler. Okay. So, my goal is always to get out all at once at the area I want to get out in. Once again, I think it's a little different in your time frame versus mine, but the point you made about the scaling, it's like, it's a double-edged sword, right? I mean, I sell them early. They blow through. They go up. I can't add to the position now. Now instead of having a bigger winner, people will say, "Well, you took some risk off." Yeah, but once I start to scale, I don't care who you are. That kind of feeling feels good to start taking that profit. Next thing you know, you're overscaling. It
Yeah.
is a balance. It's not something that's really easy to do. And I think for me as a futures trader, it also is going to depend on the product sometimes. Like a
Hmm.
NASDAQ, I have to scale because these
Hmm.
prices, I have no idea. But with S&P, I don't scale as much.
Hmm.
So, with a slower mover, I think you don't have to be as big of a hurry to scale versus something that's like, the NASDAQ.
But also at the same time, everyone, because that's again the psychology. People are looking at it, I guess, from a state of fear that they're going to lose their profit. But when you're doing this long enough, I'm sure you've been there, Anthony, where I was trading stocks and you took this small profit and you had a good feeling this was going to be a big winner, but you took your small profit, you stepped aside, and you look back after 6 months to say, if I would have just kept my original position, I'd be retired right now. One time,
I mean,
and that one time that frustrates you. When you see that 10 times, you say, I got to sit back and kind of reassess what my strategy is here. And that's kind of the way I got to this.
I can't even go into what I've done in Ethereum. It's just sometimes I'm surprised
the
at
life of a
myself and how
trader.
bad I
There's
can
nothing
be.
like it.
It's unbelievable, right?
Yeah.
No, and like I said, there's a couple more questions here, but I think that this one's we're going to take two more before I let you go. One of them is from Om Parakash. He's asking, I butchered your name. I'm sorry, man. What good books to read? You talked about all these books you have behind you.
Right.
What are some of your favorite books that you think traders should read?
I've read, I think if you wrote a book, especially technical analysis in the past 30 or 40 years, whoever you are, I've purchased your book. So I've read a lot of them, but the problem is almost if you read too many books, you don't know which way to go anymore. So I think you have to find a strategy that works for you and then have to read a lot of books to reinforce your thought process. So with the way I approach the markets, the main book that I would always recommend is How to Make Money in Stocks by William O'Neill. Actually, everything written by William O'Neill. He's a phenomenal, a legendary investor. There's Reminiscences of a Stock Operator, again, written 1927. But if you trade long enough and the longer you trade, the more that book will speak to you. Every time I'm in a drawdown, I reread that book. It's phenomenal. I like the book Winning on Wall Street by Marty Zweig. He talks about monetary policy, the Federal Reserve, and it's got some really good eye-opening stuff in there. I gotta think what else. I'm trying to think of the best books to read. Those are really some of my favorites. There's a lot of good stuff. I mean, Mark Minervini has some good books. I have to take a look at my case here.
I know you got so many behind you. Maybe what we'll ask you to do is put them in the comments later in YouTube. If you guys are listening to this, drop some of the books if there's anything you didn't mention. And the last question for today, when you go to your website, I love this about you and what you put out there. You said you have a course that teaches you how to think and act like a pro. You're not telling anyone what to think. And after hearing you talk today, it really does confirm that with me. It's the first time you and I have actually spoken. We've been following each other for years. Couple of Italians traders out there, but no, and I think this is such an important point. I want to leave on this note because I think that it ties into a lot of what we discussed today. Learning how to think as a trader. It's why I asked you that question about William O'Neill. I said, why can some people make money trading that and other people can't? There's a reason for that because he's teaching you how to think. I think a lot of people are looking at that, having him tell them what to think. And there is a major difference. Talk about that.
I think that's 100% true. And that's one thing when you start working on a trading desk, you'll notice no trader ever asks another trader, what are you buying right now? Or what should I buy? I mean, it's almost like you don't want to bring yourself to be that guy. Like, shouldn't you know what you're doing kind of thing? So you're always going to discuss process, psychology, what did I kind of do wrong here? And so, I mean, after I had a good run in the championship, a lot of people asked me to put together about my process. And I thought about it, I said, like, I'll only do it, but I don't want it to be another thing like buy here, sell there. It has to really be, I want to be kind of next to you like I was on the trading desk with the people who kind of showed me some tips and tricks. And really, that's why, how to think and act like a pro. The whole point is after the course, I explain why I do everything, how I do it. So you can take it and you can adjust with it. It's not when this indicator gets oversold by. That's not the way I approach the markets, as you can tell from the talk today. So it's all about getting into the mindset of a professional investor, whether even if you're a part-time investor, it doesn't matter. You still want to have that same skill set. And that's really what I tried to bring that's different. And I break down each aspect of the process, why I do it that way, and how you can probably adapt it for yourself in your own situation.
So well said. So we'll put everybody, actually, we'll drop a link in here if we could later, Matt, put a link in the comments here on YouTube, and maybe a link from the Twitter spaces for people to go and check that out. What Matt is doing is one of the most important things for traders. If you can learn how to think, then your ceiling's unlimited. If you're told what to think, you're limited to what someone told you how to think. And to me, that is just goes back to even that tweet I put out. There's a big difference between learning how to trade and learning how to be a trader. Highly recommend you go and check this course out by Matt. Matt, you're just a good dude, man. I got to tell you what, I learned a lot from you. I always love speaking to traders that are trading differently than me, different products, and how you open my eyes today to how you approach the market. Taught me a lot on how you think and how I should look at maybe trading some of the stocks that I do, because I don't just trade futures, but I do trade some stocks. And like I said, I learned a ton from you today. I can't thank you enough for taking the time and dealing with the spaces and the YouTube. We had a lot going on here, everybody. It's the first time. Like I said, I'm not sure anyone else has done it, man. We did it. We got through it.
Trailblazers.
So, Matt, tell everybody where they can find you quickly on Twitter, and that's it.
Perfect. Yeah. Twitter, my name is @trader_M Caruso. My website is carusoinsights.com. And Anthony, thank you so much for having me. I've been listening to your shows. It's a pleasure to finally be on. It's just always great content. And anytime, I'd love to come back. It's always great to talk to a fellow pro.
Yeah, man. Like I said, thank you so much. Learned a ton from you today. I really appreciate your time, and I'm definitely looking forward to having you back on the show. Everybody, thank you so much for tuning in today on the Twitter Spaces, my first one that I'm hosting. It will be recorded. It should already be recorded. It should say it's recording on there. It'll also be available on iTunes. We are here on YouTube for everyone joining us here on YouTube, and later it'll be on iTunes and everything else, everywhere else where my podcast is available. That's it for this live stream this week. Remember, everybody, every Wednesday at 12 Eastern, I will be live for the Futures Radio Show podcast. Have a great week, everybody. See ya. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.